On November 1st, 2015, a man is driving across a bridge in eastern China on his way to celebrate his grandmother's birthday. He never gets there. Somewhere in the middle of the Hangzhou Bay Bridge, traffic begins to slow. Then it stops. For nearly half an hour, one of the longest cross-sea bridges in the world is effectively shut down so the Chinese state can arrest a single man. A traitor. The man in that car was Xiang, one of the most notorious traitors in modern Chinese history. But before Xiang became China's most wanted traitor, he was something far stranger. A market legend. A retail trader who turned speculation into myth and built influence inside a system where power was supposed to belong to the state. So who was Xiang really? And what did he do that made China shut down an entire bridge just to catch him? This is the story of how China's most wanted traitor outsmarted the CCP. Xiang was born in 1977 in Ningbo, Zhejiang. He grew up in a working-class neighborhood of cramped housing blocks, small shops, and families trying to get by. His parents ran a modest tobacco and liquor shop. They were ordinary people living an ordinary life. No political connections, no financial dynasty, no head start. And then, China opened a door. On December 19, 1990, the Shanghai Stock Exchange officially opened. For most people, it didn't mean much. But for some young men, it was an opportunity. For Xiang, it was an invitation. While most kids his age were worrying about high school, Xu was already being pulled toward the market. He was obsessive, self-taught, and completely locked in. Studying the market by reading books, attending lectures, and digging into foreign investment methods. Then in 1993, he made the decision that defined the rest of his life. He skipped the college entrance exam. In China, that was not a small move. For most families, the Gaokao was the path. Xu walked away from it. Instead, he borrowed 30,000 yuan from his parents and opened a trading account in his mother's name at China Galaxy Securities in Ningbo. That was it. Later, Xu would say he had really been born in 1993, the year he began trading. And in a way, that was true, because whatever he had been before that moment no longer mattered. From then on, there was only the market, and Xiang was about to grow up with it. As Xiang's reputation spread, so did the rumors. By the late 1990s, Xu and a group of like-minded traders had turned the Galaxy Securities Trading Hall on South Liberation Road in Ningbo into their unofficial command center. They specialized in hyper-aggressive short-term trading. Xu was their leader, and they'd become known as the Ningbo Death Squad. Their reputation became so extreme that traders started saying, if you didn't follow the moves on South Liberation Road, not even God could save your portfolio. At the time, China's stock market was still in its infancy, fragile and easy to push around. The Death Squad specialized in cheap, obscure stocks, the kind nobody cared about, until Xu made them care. Their method was simple, which was part of the problem. They'd place massive orders for specific stocks Xiang chose, which drew the attention of other traders who would rush in to buy, just like they'd planned. The buying pressure drove those stocks toward their daily 10% limit. Once a stock hit that ceiling, momentum took over. More traders piled in the next day, hoping for easy money. Then, on cue, Xu and his death squad would get out. They sold into the frenzy, locked in profits, and left the stock to fall back down once the excitement faded. In the US, it might have looked something like penny stock manipulation. In China, the risks were even higher. By then, he was already managing a capital pool of around 100 million yuan, and yet he still lived and operated like a ghost. Then, in 2005, Zhu left Ningbo and moved to Shanghai, and his timing was perfect. Just as he arrived, China's stock market exploded into a historic bull run. The Shanghai Composite surged from a low of 998 points to a record 6,124 in 2007. For most traders, it was a boom. For Xiang, it was a bigger stage. And in December 2009, Xiang made it official. He founded Zexi Investment with a registered capital of 30 million yuan. A few months later, Zexi launched its first fund with 1 billion yuan. Almost all of it was Zhu's own money. Zhu, meanwhile, barely looked like the CEO of a major investment firm. He dressed casually, disliked management, and stayed focused on the only thing he seemed to care about: trading. And the results were absurd. In its first year, the Shanghai index was down 14.31% over the same period. Zexi number 1 returned 71%. Zhu was being called the god of stocks. Zexi's products were rarely sold through traditional channels, which fueled speculation that Zhu had access to powerful political connections. True or not, his influence was obvious. When a Zexi-backed fund appeared in a company filing, retail investors rushed in. At one point, the hype got so extreme that some listed companies reportedly used shareholders with the same name as Xiang just to trigger a rally. And his methods had become far more sophisticated. Stake disclosures, private placements, precise exits, and trend-driven speculation. To outsiders, it looked like magic. To Zhu, it was routine. Then came 2013. By 2013, Xiang was no longer just trading stocks, he was staging them. At the center was Xiang, the architect, working behind the scenes to push prices higher in the secondary market. Then came Yang, who linked Xu to the executives of listed companies. Together, they offered something hard to resist: an exit. If Xu could drive up a stock, insiders could cash out at huge premiums. And that was the setup at Zhejiang Ming Jewelry. Through Zhu Yang and the secretary of chairman Qiao Guoqi, Xu connected with chairman Yu Tuliang, who wanted to turn paper wealth into cash. The deal was simple. Yu would follow Xu's instructions at specific times, and the extra profits would be split 50-50. Then, the bait was set. Zexi number 4 and Zexi number 6 appeared in Ming Jewelry's 2013 annual report as top 10 shareholders. That alone was enough to move the market. Xu's name drew in retail investors, and within 6 months, the stock rose from 14 yuan to 28 yuan. Then came the handoff. Ming Jewelry announced a major block trade divestment by its controlling shareholders, a clear sign that a buyer was already lined up. From June to August 2014, they sold 43.4 million shares, cashing out 1.04 billion yuan. The shares were absorbed by 3 Shanghai brokerages, including a known Zexi stronghold. Now, the stock needed one last push. So Ming Jewelry rolled out the story, an online education partnership that later proved to have no real substance, followed by profit forecasts aggressively raised to keep the rally alive. According to insiders, Xu personally made 160 million yuan trading the stock, not including his 50% cut of Yu's extra gains. And then, just like that, he was gone. It didn't take long for the extent of the damage to become crystal clear. Ming Jewelry's performance fell apart for 2 straight years, and what looked like an earnings boom in 2014 began to look more like a trap. It was fast, quiet, and brutal. In 2016, as the investigation deepened, Yu Tuliang and Chao Guoqi suddenly disappeared. If the Ming jewelry case was a scripted magic trick, the next case would be something even bigger. A masterclass in grand deception. In February 2010, Wanbangda listed on Chi-Next. On paper, it was an environmental protection company focused on water treatment, with net assets of less than 100 million yuan at IPO. And yet, within just 5 years, this seemingly ordinary company was hyped into a market value of roughly 45 billion yuan. At the center was founder and chairman Wang Piaoyang. Oddly, he held less than 30% of the company, while nearly 22% was held by 5 other people: Hu Anjun, Wang Tingting, Wang Kailong, Wang Lei, and Wang Shangrong. On the surface, that looked odd. Why would a founder let outsiders control such a large slice of the family fortune? Because they weren't really outsiders. They were his nephew, nieces, and sister. Family. This structure reduced direct liability, required less disclosure, and made a future mass sell-off far less obvious. Then, in 2013, the final piece arrived. Through Wanbangda's board secretary, Xiang and Wang Piaoyang were finally connected. Wang's goal was the same as so many executives before him. He wanted to turn stock into cash. The arrangement was familiar by now. Wang would follow Shu's instructions at specific moments. Shu would handle the market side. And once the operation was complete, the extra profit would be split 50-50. Then came the setup. In March 2013, a large wave of original shares was unlocked. Normally, that could crush a stock, unless demand showed up first. And suddenly, it did. Analyst reports flooded the market. Major brokerages upgraded Wanbangda to buy and overweight. Investors were given a story to believe in. Then, in May 2014, with real performance looking stretched, Wanbangda acquired Haoqian Energy, a classic external acquisition. Soon after, the company aggressively raised its earnings forecasts, and Zexi funds appeared in the top 10 shareholders list. Then came 2015. In just the first half of the year, Wanbangda released 18 strategic cooperation announcements. For investors, the stream of headlines created the feeling that something huge was happening. That's when the family prepared their exit. On March 6, 2015, Wanbangda announced a cash dividend and a plan to issue 20 new shares for every 10 held by shareholders. To investors, it felt generous. But in reality, it was closer to a casino owner sliding you a few extra chips right before heading to the back door. And the company did not stop there. On that same day, while investors were still enjoying the candy, Wanbangda released a strong first quarter forecast, giving people one more reason to stay bullish. Then, just a few weeks later, on March 25th, came one of the most brazen lines in the whole story. Wanbangda claimed its ownership structure was too concentrated for good corporate governance and requested that every Wang family member, except the chairman, divest their shares. That was the pitch. We need to sell for governance. And while the family was unloading, someone still had to keep the stock from collapsing. That was Shu's job. In early 2015, Zexi bought massive amounts of Wanbangda stock, helping create a floor under the price, while the Wang family sold into strength. Then, when it came time for Shu to leave too, he did what he did best. Using wash trades, effectively buying and selling to himself, Shu pushed up both price and volume. creating the appearance of a stock surging on heavy conviction. That pulled in more retail buyers. Then, after the stock peaked, he would slightly suppress the price, just enough to attract bottom fishers and rebound traders who thought they were getting a second chance. That was his exit. By the end, the numbers were enormous. A trading profit of over $1 billion yuan for Zexi. Xu's consulting fee, 1.76 billion yuan. And the Wang family cashed out a staggering 6 billion yuan. This would contribute to Xu Xiang's downfall, but not just yet. Wang Piaoyang would later be arrested for his involvement. Just as that operation was ending, the ground beneath China's stock market was starting to give way. Xu Xiang had just shown how dangerous he could be in a boom. Now, he was about to show how much deadlier he could be in a collapse. By mid-June, Chinese stocks had peaked, and then they collapsed. It was catastrophic. More than $3 trillion in market value vanished in a matter of weeks, and panic ripped through the country. For millions of small investors, it was a disaster. After the crash, 13 of China's top private equity figures issued a joint statement backing a market rescue. They pledged capital, urged investors to hold, and gave the market a badly needed burst of confidence. Many hoped Xu Xiang would join them. By then, he was the market's biggest name. Insiders wanted him to buy a few $100 million worth of stock, make a statement, and treat any losses as the price of reputation. But Xu refused. Firmly. He understood something most people didn't. When a bubble bursts, outside money doesn't stop the fall. Not immediately. So while others hoped the market could be saved, Xu did what he did best. He sold. He dumped almost all of his holdings, stepped aside, and waited for the panic to get worse. From a trader's point of view, it was a brilliant move. Sell high, wait for panic, buy low. In Xu's mind, that was all this was. Another ruthless but legal swing trade. That was the problem. Because in a market like China's, there are rules, and then there are the unwritten rules. Politics, optics, cultural expectations. Informal boundaries everyone understood, but nobody needed to explain. During a national crisis, those boundaries mattered just as much as any regulation, and Xu Xiang has crossed them. That alone made him hated. But to do something about it, regulators needed evidence, and one of the clearest trails ran through Metersbonway.
Metersbonway is both a retailer and wholesaler of apparel. It retails under two fascias, the Metersbonway brand and Me and City.
During the crash, Metersbonway became one of the stocks tied to the national team rescue. It was a key name recommended by CITIC Securities, and state-backed funds reportedly bought 2.905 billion yuan worth, amounting to approximately 15% of its circulating shares, in early July 2015. That mattered because, according to the case that formed around him, Xu had already been tipped off that the national team was coming. He was trading around the rescue. Zexi denied wrongdoing. It announced it had fully exited Metersbonway on April 20th, 2015, booking 450 million yuan in profit within 6 months. Investigators believed otherwise. According to the case, Xu Xiang, his parents, and other associates were allegedly operating through at least 100 A-share accounts that were still lurking in Metter's Bunway. Some positions were reportedly tied to officials' family members who had followed Xu into the stock and then got trapped when the market collapsed. Xu, who had deep ties to them, allegedly used accounts under his control to take over those positions and help bail them out. And then came the darker allegation that state-backed buying helped create Xu's exit. That was exactly the kind of anomaly the CSRC's big data system was built to catch. Xu, meanwhile, seemed to think the rumors around him were mostly smears from rivals. What he didn't seem to understand was how quickly his image was changing. Not as a genius anymore, but as a predator. By Saturday, July 4th, investors were desperate for any sign of hope. Senior financial executives gathered at CSRC headquarters in Beijing for emergency meetings. The full rescue machine was rolling into place. All 5 of Zexi's publicly listed funds reportedly gained at least 20% during the crash. One fund was up 357% from January 1st to August 5th, the best among 1,649 comparable funds. By the end of the first 3 quarters of 2015, Zexi's value had risen 218%. While everyone else was drowning, Xu was surfing the wave. The 1 commission and 3 bureaus moved. IPOs were suspended. China Securities Finance Corporation was recapitalized from 24 billion yuan to 100 billion yuan. For a moment, hope flickered. On Monday, the Shanghai Composite opened up 6%. It still wasn't enough. By the close, the market had barely stabilized, and across the 2 exchanges, 927 stocks still hit limit down. The next day, another 1,000 stock limit down followed. The panic was too deep. The liquidity crisis was spreading again. The rescue had started, but it had not yet restored confidence. And Xiang was watching all of it. Ever since the index broke below 4,000, he had been tracking margin call liquidations across major brokerages. Then, after a roughly 60% collapse, with the Shanghai Composite approaching 3,000, the moment finally came. On July 9th, he moved. The market opened weak. Xu walked into the trading room, calm, pointed at the stocks he wanted, and gave the order: go all in with the remaining funds. Literally. Zexi's 6 traders spent the morning hammering their keyboards. By the end of the session, the firm's exposure had reached a record 99%. In a single day, more than 15 billion yuan was fully deployed. This was Xiang at his purest, and perhaps his craziest. By the afternoon, some of the stocks he had bought at the bottom were already green. Some went straight to limit up. That same day, hundreds of billions of yuan in state-backed money poured into the market. The Shanghai Composite surged 5.76%. 1,286 stocks hit limit up. The next day, 1,323 more did. On July 13th, another 1,552 stocks hit limit up. It looked like the market had been saved. And in the 10 trading days that followed, Zexi's net asset value nearly doubled. This was the absolute peak of Xiang's career in the A-share market. The greatest trade of his life. He outsmarted the national team and the CCP. Shortly after the rebound, Xiang liquidated everything and walked away. But the rebound didn't last. Panic selling returned, and the Shanghai Composite crashed again, falling into the 2800s, marking a major low in the bear market. The national team had stepped in, but its resources were limited. Xiang saw the weakness and did what he always did. He got in, got out, and most importantly, got paid. With a few perfectly timed moves, Xu reportedly pulled nearly 10 billion yuan from the wreckage. While most funds were getting crushed, Zexi's net asset value surged 160%. On August 25th, Securities Daily ran a front-page article with a brutal title, "Destroying Confidence in China's Stock Market." The message was clear. Some institutions, the paper argued, had all but abandoned real research and were now focused on profiting from the National Stabilization Fund. Their behavior was undermining market stability. And if insiders were colluding with outside forces to exploit market weaknesses, even threatening national financial security, then decisive action had to follow. The target was obvious. The state was looking at him as something dangerous. By September 2015, a top domestic brokerage firm was accused of leaking insider information to Xu, including details tied to the national team's intervention. Then came the arrests. More than a dozen senior executives were taken away. In October, Chen Hongqiao, president of Guosheng Securities, died by suicide. 3 senior executives at Founder Securities disappeared one after another. What had once looked like a market crash was now revealing something bigger: a network of leaks, favors, and hidden deals. Then came November 1st, 2015. Xiang was returning from Ningbo to Shanghai, crossing the Hongqiao Bay Bridge, dressed in a white Armani suit. Suddenly, police moved in and sealed off the scene. Xiang was arrested on the spot. Afterward, the scale of his empire began to come into view. Prosecutors revealed that Xiang and his family controlled 25 billion yuan in assets, including cash, Zexi private equity shares, and stakes in listed companies held through his parents. The quiet boy from Ningbo had built an empire. Now, the state was tearing it apart. In the end, Xiang was charged with insider trading. One rumor never stopped following Xiang: that he was not just trading for himself, but for Shanghai-linked princelings, the children of senior CCP officials. While never fully proven, in China, that kind of rumor is dangerous all by itself. Between 2010 and 2015, authorities said Xu conspired with 13 company chairmen and senior executives to use inside information to manipulate stock prices and realize enormous profits. A court in Qingdao later said the defendants had severely undermined the healthy functioning of the stock market. Xu was sentenced to 5.5 years in prison and fined 11 billion yuan, the largest fine ever imposed on an individual for a white-collar crime in Chinese history at the time. Then came the permanent ban. In June 2017, Xiang and Zexi were blacklisted and barred from fund management for life. And yet, even before his trial began, associates had reportedly started registering new private fund companies in 2016. Xu was released on July 9, 2021, after serving his full term. But the system that created him never really disappeared. China's stock market remained a playground for speculation, and the same cat-and-mouse game with regulators kept going. That is why Xiang still matters. Not just because he made a fortune, or because he fell so hard, but because he exposed what China's stock market could become in the hands of someone skilled enough to bend it. In the eyes of the state, he outsmarted China. And that is the kind of thing the CCP does not forget. Neither should we.